I move, yes, amen. Let's get it on.
Welcome everyone. I'll go ahead, since we now have a quorum, and call to order the City Employee Pension Fund Board of Trustees special meeting of November 14th, 2023. And in order to keep our quorum, I'd like a motion to move number 4 to the end. That will get us through all of the voting items, we hope, before we lose our quorum. Could I have a motion to adjust the...
I think she moved it second.
So moved.
Okay, very good. Any questions? Number 4 doesn't require a vote, so that's why we want to put it at the end. All those in favor, say aye.
Aye.
Is anyone opposed? Okay, thank you for that. So we will roll right through. First item is August 31st minutes, and they're in your packet. If I could have a motion to approve.
Move to approve.
Thank
Second.
you. Thank you. Now, are there corrections, additions, questions? No? All those in favor of approving, say aye.
Aye.
Anyone opposed? All right, that motion passes. Now, the first quarter expenses are just for your information. We don't require a vote, but they're there for you to see. And we do need to ratify the transfer of payroll for October through December. And so you have your transfer letter there for $190,000. That's October through December. Do I have a motion to
So moved.
approve?
Second.
All right.
Councilman Baxter.
Okay. Now, are there questions about the transfer letter? No? All right, all those in favor of approving, please say aye.
Aye.
Is anyone opposed? Okay, that motion passes. Now, we will, let's see, we've moved 4 to the end, and we are to number 5, which is the 2023 Actuarial Valuation Report. And I'll ask our visitors to introduce themselves. Let's see. Are you doing this? You're 4. Oh, that's right, you're 4. Okay. What's this, page 6? Okay. Now, this does, I think, require a vote to accept it.
You're correct.
So, how about we do a motion, and then we'll have
Yeah.
questions and comments and concerns. So,
Yeah.
do I hear?
Yeah, I move to accept the actuarial report as provided.
Thank you. Is there a second? All right, Councilmember Fogel. Now, this is interesting. How long had it been since we had the actuarial done? Do you remember?
Do them yearly.
Pardon me?
We do them yearly.
Yearly, okay.
Is the actuary here?
No.
No.
Okay.
What sorts of questions and
I've got
concerns?
I've got a-
Councilmember Savigny.
Quick one. Yeah, so it looks like on 9/30/23, our liability defeasing portfolio is $7.894 million.
Where are you?
I'm just looking at the report from, or the financial report.
The written
right?
report.
Yeah, the report that's going to be the last thing we review, I think, is this piece.
This one.
Oh,
So my question in general is, if that's 7.894 million, and according to our actuary, our liabilities are 5,528,000, like, it would appear that we're running a substantial enough surplus in the liability defeasing portfolio. Would that be a generally good understanding?
Yes.
would you introduce yourselves,
Yeah,
please?
Hi, yes. Floyd Simpson from PFM. I'm actually one of the investment committee members making decisions over all of
Yeah.
our outsourced CIO portfolios.
Allison Corbally. I work as the client service officer in Atlanta.
And so definitely per that, based off of your current liability balance of being 5.5 million, for the liability. Your liability defeasing portfolio being, as of 9/30, 7.8, 7.9 if you really want to round all that
Right.
up. That's definitely a healthy surplus. That essentially means that not only by the time that you get to the final years will you have money left over, it probably will be a little bit earlier than expected. I think in yours, I didn't have a chance to go through this, but I think you have a 15-year amortization period.
That's what
Yes,
they're using.
that's right.
So, so basically you're not at risk. And then currently all of your liability defeasing portfolio, it's laddered. So, so essentially your cash flows are covered. So I would say, you're good. I mean,
Yeah.
usually if you're over 100%, definitely, but once you're over 120%, actually 120%, and then looking at the yield for your portfolio, you can meet everything you need to meet. You're good.
Yes. Were you going somewhere
Well,
with
I was
this?
just, where I was going with it was, at some point, I would expect a recommendation to possibly transfer money from the liability defeasing portfolio to the return-seeking portfolio.
Mhm.
And I don't know actually who makes that recommendation, if that's this board or
Mhm.
or if we get advice from our advisor to say, hey, like, if you're over 120%, like, you start to not be a good steward of the money, and you should do this, you should transfer money. And I don't know if we do that, or if they recommend it and then we do it.
That would be, well, I think that would be a discussion, but we would have to recommend that.
Yeah, okay.
Yeah.
Yeah.
Um,
I just wanted to
great
point it out,
question.
because I think it's just,
Mhm.
it's something that, it's the time of year when you do these actuaries that you look at that, and make sure that
Mhm.
you're in good shape.
Mhm.
And at that point, we would work, if that was a decision you wanted to move forward with, we would work directly with your actuary on coming up with a recommendation of how much to move based upon the objectives.
Okay,
So,
okay,
close
that's a
with
great
your actuary.
question.
Yeah.
I really appreciate that.
Yep.
What other questions do you have? Board members? Any others? Okay.
I think one thing they did, I'm sorry,
Mhm.
I did read it, and I think they assumed, like a 3%
Mhm.
raise or
Well,
something like that.
COLA.
It's the
COLA,
COLA.
but I know that this year we did a bigger one, right? We did 5.
Mhm.
So
Yeah.
that was one thing that, if we probably did that while they were doing this, so it's just something.
But we've done that for 2 or 3 years, or
I think 3 to 4.
3 to 4 years.
I
when-
think 2020 was the only year we
Mhm.
didn't.
Yeah,
In 2020, if I recall, we did not give our employees a raise. Is that correct? So we didn't do anything with this group, but starting in '21, we gave our employees raises, and we wanted to sort of mirror that. So it's been done for several years. Presumably, the actuary
yeah, he did.
Saw that.
If you look at the bottom of page, on number 3 of theirs, in their section 6,
Mhm.
they basically said cost of living adjustments 3. Do we
Yes.
do a different cost of living adjustment and a raise? Do we do that differently? I can't remember. Or is it the 5% is 5%?
We do a
The-
COLA of
We
3%
didn't.
across the board
Okay.
for
Yeah,
everyone,
yeah,
per ordinance.
We do what?
We do it 3%.
3%.
Per ordinance for everyone, and then if you elect to do anything additional, that happens in January.
So that was the 5%?
Yes.
So we actually did a, so all I can say is their number then is wrong on number 3, because they have projected salary increases. It probably should say 5%.
well,
Based on the ordinance.
yeah.
Yeah, that's what
The-
we're required to do.
I mean, they're not, it's two different things that, we don't have to do our 5%. That's been a year-by-year decision. I don't know if that makes any difference in their reporting.
Well, they'll basically, if we say plugged in
Yeah.
5% there, this number of $5.5 million would probably be $6.5.
It's a little incorrect.
Yeah, it's a
Yeah.
little incorrect.
But they would have, we've done this several years, so,
We put it in code
Oh,
every time
Chad.
too.
Chad,
I just want to point out that the raise is happening in January of
Yes.
5%. This is as of June 30th,
Yeah.
2023.
Yeah.
So it is accurate as of June 30th. Where this will be reflected, this 5% is next year.
uh-huh.
Okay,
In
they'll jump up,
FY24.
they'll jump it up.
So you'll
They'll
see
jump
it a
up
little
their
bit. Now,
amounts.
it will be probably a negligible amount,
Yeah.
Mhm.
but that's when you will see it.
Got it.
That's-
Yeah,
You
that
have to
makes
have a
sense.
cutoff date for
So,
the study.
so in July, they reflected the one we gave last
Yes.
January? Okay.
Yes.
That
And
makes
They
sense.
look at all the payroll data.
Mhm.
And that is reflected in the setting as of June.
Okay, okay, that makes sense.
I'm good.
Yeah, okay. Anything else? All right, all those in favor of accepting this report, please say aye.
Aye.
Is anyone opposed? All right, that motion passes. Now, we are down to number 6, and I would ask you all, please, to leave the room, and there's a semi-comfortable place to sit. Pardon me? If you take a right out there, and Samantha's going to be sure to show you and get the lights on, and we'll come get you when it's time. We may get through this whole meeting before you have to leave, which would be awesome.
Which would be nice, let's do it.
Yeah, yeah. Thank you very much, Samantha. Now we get to the big one.
Yes.
Because they are with PFM, they
Yeah.
couldn't be in here
Yeah.
when we discussed this. But, so this is the one response we had to the RFP. That was all we had. So, and it's not surprising.
Is there
It's,
someone from purchasing here?
we do not have anybody from purchasing here. Chad, you've had a look at it, haven't you? Yeah. So the idea is the basic goal here is to determine if we want to accept this proposal. And does everybody have access, semi-access? You have it electronically. Aren't you smart?
Did anyone know, did anyone, because I didn't go through this whole.
I went through the whole daggone thing.
Good.
Oh, my gosh. And I'll just kind of preface this, maybe Chad, you can agree with me or not agree with me. I don't believe we expected a lot of responses because this is a closed system that's going away
Yeah.
eventually, and it's not a huge amount of money in the land of, I think of our police and fire pension, for example, close to $1 billion. So I don't think it's unusual we got just one response.
Mhm.
I don't think that should be concerning. Is that
No, that's fair.
your,
And
yeah.
did they change their basis charge, like basically their points that they charge us?
No, it's staying the same.
Is
Yeah.
it staying the same?
These stay exactly the same.
The fees are
Yeah.
the same?
And I'll be honest with you, it's a very generous fee.
Yeah.
So last year, at the end of June, the plan was valued around
Which is
33 million,
good.
and we paid 56,000 in fees.
It's
Uh,
very
for PFM.
generous.
That's
Yeah, that's
really low
pretty cheap.
in the realm of
Mhm.
institutional investing.
Yeah,
Mhm.
okay. Yeah, that's kind of what I was the most interested, I mean,
Mhm.
because it, and since I didn't go through it to see if was there any term that they didn't meet of our RFP? Is there something that they
No.
said they didn't
No.
meet? Okay.
Yeah. And they, let's see, I can't remember where it is in here, but they did, you remember our discussion about allocation? And they did follow what we requested. What else?
They didn't really provide any of their minority forms, or it looks like they basically responded no. That's the only thing I would say. But since we only have one response.
I mean, I might, as a layperson looking at this,
Yeah.
my thinking was it's a pretty good proposal.
Yeah.
It's really what we asked for.
Yeah.
And thank goodness somebody will take on a closed pension that's dwindling, so to
Yeah.
speak. Chad, did you have any concerns about it when you went through it?
No, not at
No.
all. I think we're fortunate that they did respond.
Mhm.
They did. You know, PFM has been working with the city in itself for 13 or 14 years, the various areas that they have.
Mm-hmm.
And, you know, they're very generous. So, like I say, you know, fees are everything in a lot of ways, and it's a good deal.
Yes, I thought so too.
Do you need a move to it?
Yes, we do need a motion to approve this.
I'll move to approve the bid response by PFM Asset Management.
Okay, thank you.
Second, that
Councilmember.
huge book.
Councilmember Fogel seconds. Are there any other questions or comments? Okay, all those in favor of accepting the proposal, please say aye.
Aye.
Aye. Any objectors? All right, now my question is, first of all, this doesn't have to go before council, does it, or does it?
I don't know.
I don't
No.
think so. Okay, then how do we notify them, since they're here, that we've accepted their proposal? Is there a formal way that normally that is done?
No, and there's not a formal way, it could be a phone call, but then there is an example of their contract that you all would have to sign, probably you, Mayor.
Okay,
Would have to sign. And what is in the RFP is just sample, it would be
Right.
the same thing, but
Right.
they would send us.
yeah.
You know, copies that we could actually sign.
So I guess what I'm getting to is it appropriate or inappropriate to say anything to them today? Do we wait for a formal channel to do that?
You're out of my area of expertise.
Oh, boy, law
I would-
or somebody? It seems like we would want to do the formal channel that we do with every other RFP.
Yeah.
I
Okay,
would do that.
okay.
Because to be honest with you, I don't know if they know that we only got one response.
I don't think they
Yeah,
do.
we don't need to tell them.
And we
do
don't
not
need to tell them.
Alright.
So we're just going to
So-
leave this for the formal channel that we
Yes.
would do with any other RFP
Yeah.
and say congratulations,
Yeah.
thank you, et cetera.
Of course, they'll see that, oh, there's just ours sitting on the table, so.
Well, they don't know what's under it.
Yeah.
They know that they did all that. They know that.
I bet they haven't printed it out. I don't know how thick their proposal is.
Okay, thank you very much.
Yeah. We can bring them back.
So we'll not say any more about that.
Do we need to do anything here to give her permission to sign formal documents?
With the approval of the RFP.
That's, you
Okay.
just did it, I
Okay.
think.
Right.
Because you had the one in here, I think, that Mayor Gray had signed, right? Or as an example, not you, but, okay, very good.
Yeah, yeah.
Do you want to go get them, please? So we only have
And
one
then,
more
oh,
thing.
these are new people. Like,
Well,
so what-
Khalid couldn't come,
Okay,
and David couldn't come.
okay.
So that's why
This
Al.
has been here before.
Yeah,
Has
he's
he?
been
Okay.
here before, yeah. And Allison was filling in for Khalid.
Okay, great.
Yeah.
Just wanted to make sure.
Yeah. Yeah. I came in and I said,
I was
who are
like-
you?
years.
Thank you. It's a, yeah, because it's, nobody really needs to take it on. Let's get on next week.
I am kind of ready.
Welcome back. So, your item on the agenda is up. So, the investment performance review, and I think everybody has a copy. So, we'll let you take it away.
Thank you. I'll start out on the page 4, the first section of the portfolio. It has a book in front of them. In reference to the market values for the two combined portfolios, it was just north of $32 million, with the liability defeasing portfolio at close to $8 million and the return-seeking portfolio at $24 million. If we look down at your funding ratio, I know that we included for this packet through June 30th, we didn't have the updated actuarial report, but from what we do understand, it has gone back up past 510% for the year 2023. We didn't have it in time to incorporate in the book today. If we look at performance for the two portfolios on the following page, in just looking at the third quarter for 2023, after the market posted positive gains for the first half of the year and actually into July and August, September brought a lot of volatility into the marketplace. A hawkish tone from the Fed that longer interest rates or higher interest rates for a longer period of time set the markets into much volatility and turmoil. Both the equity markets and the fixed income markets posted negative returns for the quarter. The return-seeking portfolio was down 3.6%. We underperformed the benchmark about 32 basis points. Really, all markets moved in a negative direction, equities and fixed income combined. The only safe haven for a return, a significant return, was in commodities, and particularly energy. On the liability defeasing portfolio, with the increase in interest rates, we found that the impact of the fixed income securities were in negative territory for the quarter. This portfolio consists of corporates in the short term, and you have treasuries in the long run in this portfolio, out longer on the curve for the portfolio. We did make a few changes to the portfolio during the third quarter. One in particular for the large cap in the U.S. domestic equity side of the portfolio. We reduced our overweight to U.S. large cap. We're somewhat neutral as our exposure in U.S. equities. And for international, the non-U.S. equity side of the portfolio, and I'm referring to the return-seeking portfolio, we increased our exposure to emerging markets, but particularly not to China. China is grappling with some significant issues, not recovering from pretty much a lackluster economy, failing to recover, and concerns about healthy earnings and in the property sector, not to mention demographics as they're dealing with in China. So we have an underweight to China in the emerging markets. So we added an international small cap exposure in the portfolio to broaden out your exposure in the non-US equity space. And then in the fixed income, we removed a short duration exposure in the portfolio for fixed income, and we have that included in the portfolio holdings, which is in the back side of the presentation. If we look at the performance for the trailing 12 months on the return-seeking portfolio, we have a positive return, about 10.7% versus the benchmark 12%. And if you do recall, in a portion of that 12 months consists of one earlier part of this year, The portfolio, the investment team took an overweight to small cap and mid cap equities on the U.S. equity side. This was just prior to the demise of SVB and Signature Bank, where the regional banks were significantly impacted. And those particular issues fall in the small and mid cap category. We had taken that overweight. We did trim back that overweight in the second quarter of this year, but it impacted the returns of the portfolio. And then somewhat in 2022, the tail end of 2022, some of our international equity managers didn't deliver the performance that we anticipated in the portfolio, and impacted that performance. For the liability defeasing portfolio, it's a positive return of 1.4% for that portfolio. And then we did a combined of a positive 8.2% for the 12 months ending September. And then the last page here shows the total fund return, and it's the combined portfolios versus the blended benchmark. You can see that for the 1 year and 2 year, we are behind the benchmark, and for the 3 year, we're slightly above the benchmark, slightly below on the 5 year, and above on the since inception in 2015. And really a lot of this has to do with 2022 and the selection of the international equity managers, and particularly for the first part of this year, where we took that overweight to small cap and mid cap. Just the timing of that investment didn't bode the portfolio well. Didn't anticipate that there would be a collapse in some of the regional banks.
Any questions on so far? Okay.
We have included here some more robust pages on the market and the economy, and also the portfolio. Happy to go through those. I know that Floyd would like to talk about our positioning in the portfolio, because that's important as we move into the tail end of 2023 and into 2024. And then as what we're looking at as it relates to the economy, and then what's going on in the marketplace right now. There's a lot of moving pieces from a monetary standpoint, a political standpoint, that may be worth having the conversation to have today. So
Okay.
Would you like us to go through some of these charts, or would you like us to talk right about the overview of the portfolio and positioning, and then encapsulate that with some factors to consider?
What's your pleasure?
The second.
Do you want to go on to the
So page 20?
performance?
Yeah.
Mhm. Okay.
So,
All right.
so on page 20, your portfolio, in our view, is that on this slide, you'll notice that we're essentially neutral almost across the board except for two places. Why are we neutral? When you're looking at a lot of the opportunities going forward, they're a lot less than what they were at the beginning of the year. If you think about the beginning of the year, most people thought that the economy was going to fall off a cliff.
Mm-hmm.
We were in the group of it's not going to fall off the cliff. It actually looks pretty good, which we were right in that aspect. But again, I think we did not project, and I think nobody projected SVB and seeing some of those bank runs happen at that point in time. That just nobody could foresee that. But beyond that, what are we looking for going forward? We understand that there's more risk within the environment. We do know that now that everybody understands that it's higher for longer and that the world's not going to fall off a cliff, what are the things that we're not paying attention to? And I think that's the one thing that I spend a lot of my time focusing on, and the team spends a lot of their time focusing on. So instead of us saying, hey, we want to be significantly overweight certain places, no, let's go right in the middle. Let's be prepared to play more defense than offense going forward, because we understand we were okay playing offense, but now it's definitely a time to play defense, because there's more things that can happen on the downside than on the upside. So that's essentially what's reflected on this slide. The one thing to note would be within fixed income, for the credit sensitive sectors, we are slightly green. We're in the slight green for that portion. And think about that as, corporations, businesses, especially large businesses, they still have a lot of cash on hand. They haven't had issues with people spending. And so what does that relate to? That relates to them actually being able to pay their bonds consistently. Their bonds, because they are, corporates, have a significantly higher yield than your government bonds, because the government is considered quote unquote safe. It depends on how you look at our government sometimes. It depends on how you look at it, but it's considered safe. But if you look at that aspect as a whole, that's why we're positive on credit. And but this is the area that honestly we're consistently overweight to. So I kind of say that with tongue in cheek, because it's like, yes, it's light green, but this is the area that within your portfolio we're always overweight. Now, the next page is the factors to consider. And, it's a lot of stuff going on this page. And one thing I think about would be focusing on the top line, and I'm going from one to another. Monetary policies, that's interest rates. I've already talked about the higher for longer. We all know that it's higher interest rates. People are asking the question of, when will interest rates be lower? Well, interest rates and inflation go hand in hand. So if my cost of goods continuously go up, then interest rates can't go down. We just had a number today. Now, it came in at 3.2, which is a little bit lower than what it was in September. September, I want to say, it was about 3.8. The natural rate is about 2%. So we still have ways to go, but this is definitely a lot lower than the 7-8% numbers that we were seeing in 2022 and even late 2021. So you've gotten down to the hard part. Getting from 7 to 5, 5 to 3, okay. Getting from 3 to 2, that's the hard part that we're going to struggle at going forward. And you see it within some of the uncertainty within the market, whether it's the third quarter returns, you're seeing it within the back-to-back volatility within the market on a daily basis. So that's where that struggle comes from. And also that's why we're neutral within your portfolio positioning. Because we do understand that that's going to be a struggle, and we do need to think about more of what are the downside risks, because it's harder to go from 3 to 2 as opposed to going from 7 to 5. But we're not alone. Europe's also in this bucket. The only country that's not in this bucket is Japan, which usually is never the country that you want to be in, whether it's equity-wise, return-wise. It's always the trailer. Why is it not the trailer? It's because Japan, for more than 20 plus years, has never had to deal with inflation. They finally have it, which is positive for them because they've never had that. So since they never had that, you finally have it. People can actually invest in Japan and get a positive return. So that's why Japan, even if we looked at it from a pure return aspect, a country aspect, positives for both for inflation.
What is Europe's inflation rate right now?
Europe's inflation rate now, because ours is 3%, Europe's is still around the 6% range. So they still have ways to go. Europe usually trails the United States. So usually when you see a trend, it starts in the United States, Europe will follow, and that's kind of usually how it goes. You see it within returns, you see it within whether it's IT, healthcare, anything else. It usually starts here and then it percolates into other places. The next box, at the economic growth. So essentially, how good do we feel about our individual pockets per se? And within here, it's people haven't lost jobs. That's a plus. But I think inflation is hurting people. But we're all still spending. We might have cut back on the spending, but we're still spending. That is a plus, but the rate that we're spending is a lot lower. Why? Because you've had a lot of people already spend down a lot of the excess savings that were there. And now it's, you're noticing that there's a tick up in credit cards usage. So tick up in credit card usage is a negative. So as you think about it, that's a negative. Interest rates are going to be higher for a little bit longer. That's a negative for those credit cards because it means your credit card rates are a lot higher. So those are some negative things that we're focusing on. But again, we understand that people are spending, and that's good. Now, the question is, will the government spend? The government has to spend because the government has to spend on defense. But the government now has to spend a lot more on just their interest rates because their bond interest, because interest rates are higher. So a big portion of government spending that goes to just how much we issued in bonds and then that debt portion, it gets a lot bigger because why? The interest rate's a lot higher. So that's something that's going to eat into some of the government spending that has to get done just on a day-to-day basis. Businesses also are cutting back spending, so you're noticing that on the fringes, and I will definitely touch upon that for the labor markets. Really handling inflation, so I don't need to hit that. I'd probably say for financial conditions, the biggest thing to think about is loans. It's harder to get loans. You have banks giving out less loans, and when they do give out loans, it's at higher rates. Also, because of everything that happened, as Allison mentioned, with SVB, Signature Bank, and even with a lot of the regional-based banks, regulation has not happened, but when regulation hits the banking world, I would not be surprised to see banks have to hold significantly larger cash on their balance sheet. They'll probably have to hold less mortgages because they cannot take that duration risk anymore because of what happened. The fact that now it's acknowledged that you can have a bank run in less than 24 hours to 48 hours.
Yeah.
It's going to essentially make banks as a whole probably look more like utilities. So, it's going to be very paltry for banks going forward. But I think that, how does that play out? Think about your regional banks, your local banks, now that depend on lending, and it's like, oh, I have to hold all this cash. I can't do as much lending. So it's going to change the way we think about the bank environment going forward, especially for smaller banks and local banks. So I think that's something, especially here and other places, like when I talk about stuff, like I try to get people to think about like this is where it starts to impact your local communities. And you'll see it, not today, but you'll see it in the future tomorrow. The labor markets are good. I mean, if you're looking at unemployment's still below the natural rate. I want to say even earlier in this package, we have a number of about 3.8 should be that unemployment number. And it's interesting about unemployment. Unemployment, before, if you go back in the middle of last year, there were about 2 jobs available for every one unemployed person. You now have about 1.5 jobs available for every one unemployed person. The one thing about the unemployed person that's going to start to show up, and this comes into the business and the corporate fundamentals, that businesses are quietly, especially larger businesses, are quietly laying off people here and there. And when you do that, there's 2 things that signals. One, that means that I have to hit my earnings number, and I don't think I'm going to get it with higher revenue. But 2, I see a slowdown, and I should expect that within the economy, and I'm expecting that within the economy as a whole. So that's an indirect signal that I'd probably say those layoffs that you hear about, a couple people got let go over here, it wasn't a mass layoff. Those are things that trigger like, okay, something's coming down the pipeline that you have to be aware of, and you have to get ready to play defense. Companies as a whole, despite that, they look good. I mean, they have good cash on their balance sheets. Their debt to income ratios are actually very low, actually in comparison to a lot of consumers. Consumer debt to income ratio is a lot higher. And what makes it even interesting about consumers is that when you have individuals that make $100K and over, and you have bank tellers essentially saying, yes, they have their debt to income ratio is a lot higher. They can't even get loans. That lets you know that something else is going on behind the scenes. So just something to think about as we go forward. There's a lot of good things, there's a lot of bad things, but that's out there. You have to measure those 2 and keep that in balance. And then last but not least, the political risk. You have, U.S. and China. I'd say that's a de facto Cold War. You see still Russia and Ukraine, even though it has not dominated the headlines just because of everything going on in the Gaza Strip, it's still there. And then I'd try and say here, our political situation seems like it is, I don't know, a calamity, a cartoon, however you want to say it sometimes.
What is the word?
But, what's going to be interesting, especially this go around, because it seems that both parties, the front runners right now are just so polarizing, is will the actual third party, this Ford party that's supposed to be more centrist Democrats and Republicans, will it actually be a viable party or not? You think, last time you really saw the third party impact an election was with Al Gore. That third party actually took votes from Al Gore, which was why Al Gore, became the Al Gore Internet versus Al Gore the president. So, you see it there. So the question is now, like, where will that third party stand, and then how many people will be with that third party? So that's going to be an interesting development. Despite it all, when you look at markets throughout these political years, they're a little bit more volatile, but at the end of the day, the main themes that were before the political runoff are still the main things at the end of the political runoff. So that is still the one constant. The long-term themes, the things that have to happen within the economy, those carry through. You might see the volatility with all the rhetoric between the parties, whether it's the Republicans, Democrats, or even now throwing the Ford party. But at the end of the day, the long-term themes always drive what's going to happen in the economy.
Okay. Very interesting. Thank you.
All right, with that, any questions? I mean, we could dive deep into the portfolio if you would like. It's your time.
Any questions or thoughts or?
I just have one. Is there a
Yeah.
reason why in the liability fee, and we probably have it, I think we have it specified in the liability leasing portfolio, we didn't just move to like money markets that are paying 5%
It's laddered to your cash flows. So your projected cash flows, that's what it's laddered towards.
and then, so you're just kind of rolling them.
So in rolling, but even more, when it's, because it's laddered to your cash flows, when you have that cash flow that technically hits, let's say 6:30 around that time frame,
Yeah.
that money just goes right out the door. So within that portfolio, you're holding all your bonds to maturity. So we're not doing any real trading within there.
Right.
So that's where the comment when you asked earlier, and I was like,
Yeah.
over 120%, you're usually pretty good. I think for this one comparison, it's about 150%, but once you change from 3% to 5%, that might change some of the.
And if we're holding them to maturity, is this value actually important or not that's in that, since it's being held to maturity?
Not really.
It's only if they default, I would imagine.
Correct.
Yeah.
Their
So,
treasury.
I
okay.
asked that same question at
Yeah.
the police and fire pension
Yeah.
meeting.
Yeah,
'Cause
because
it-
they get marked to market, even though
Yes.
there's really we're not marketing them.
Right.
Because I think a lot of, to your point, Dave, a lot of individuals
Yeah,
have seen that as an opportunity.
yeah,
Different kind of situation.
right.
Right.
Right, so.
Okay, thank you.
What else? Other questions or concerns or? I really appreciate your report very much.
And I guess my last bit, have you had anyone on our account change, anyone on any of these change in your organization? Any of the portfolio managers change?
No, so
added.
we added one person, just because of the acquisition that happened years ago with PFM and US Bank. One person came onto the investment committee, Patrick Mahoney. So Pat and I actually sit hand in hand on the investment committee making decisions for the portfolio. I would say within there, what he provides is, he brings over some governance from, I would say, US Bank, also some of the risk management tools. If I think about it from your portfolio, how does that interact with it? It allows for, in my view, better management of both the managers within your portfolios, a deeper dive into that, along with better oversight over some of the asset allocation. We've done very well in asset allocation. It's just been a hiccup recently, but I think that, those two elements add a lot and will be beneficial for your portfolio going forward.
Yeah.
Very good. Anything else? All right, thank you so much.
Thank you.
Yes, really appreciate you both being here and this report. So that pretty much brings us to the end of our agenda. I do want to take a special moment to thank Director Tammy Walters, our HR Director. This is her final meeting before your retirement.
Yes.
And we so appreciate your dedication and hard work in many areas. I know that because she's our Human Resources Director, she automatically has to do certain things, like serve on this board.
It's been my pleasure.
Yes, and we'll welcome our new Human Resources Director, Glenda George, next time.
Awesome.
So, thank you so much for everything.
I appreciate it. Thank you.
Yes. And enjoy your retirement, however long it lasts.
That's what they tell me.
All right. So, is there anything else for the good of the whole?
We just have 4 meetings next year.
Yes, January 30th is our next meeting.
Okay.
And we just have 4.
That's
We
great.
ran into some hiccups with quorum
work,
and,
yeah.
yes.
Well, and we also
past
have to
year.
rebid the RFP
Yes,
thing on it.
yes.
Yeah.
So we hope it will be just 4.
Sounds great.
All right. If there's nothing else, is there a motion to adjourn?
So moved.
Thank you. All those in favor say aye.
Aye. Thank
All
you.
right, we are adjourned. Thank you very much. Have a wonderful Thanksgiving, everybody. Thank you so much. Appreciate you.